Good afternoon. I want to thank everybody for logging in and calling in today for our webinar, a special two-part series we're doing today and next Wednesday at the same time at noon on real estate and an IRA. Today, part one, we're really going to talk about the do's and don'ts, going over a little bit more how things get formed, how things get started, and talking a little bit more on the rules involved as well with buying real estate through an IRA account. On next Wednesday in part two of our webinar, we'll talk more on how to structure the transaction, how that works, what the steps are, what the process is for doing this type of an investment inside of your IRA account. So today's kind of a part one. Next Wednesday, part two. So we're breaking these up, kind of little shorter webinars as we go through, and hopefully get more people to engage and get more out of these shorter webinars rather than stretching it out over a full hour. So my name is Scott Maurer. I'm the Education Director for Advanta IRA. I've been with the company now for over 10 years. My roles here at Advanta, I've helped people their purchases, making different investments, whether they are buying real estate or private notes or private LLCs, helping them through that process. And I've transitioned more so in the last few years really to overseeing more of the education and business development side of the company as well. Quick disclaimer for Advanta. Well, a couple of things we don't do, and maybe this getting into the don'ts a little too early from our do's and don'ts, but some of the things we don't do at Advanta is we do not provide any investment advice, and we don't endorse any products. We exist strictly as a record keeper and an administrator for self-directed IRA accounts. So we don't get involved in tax decisions and legal decisions, and certainly not in making investment decisions for self-directed IRA accounts. We can certainly point you to professionals in those fields, whether it's an attorney or an accountant or a financial advisor to help you make decisions. But when it comes to buying assets within a self-directed IRA, whether it's real estate that we're talking about in this two-part webinar, whether it's notes, private placements, etc., if things make sense from a legal perspective or from a tax perspective or from an investment perspective, those decisions are up to you as an individual to make, but again, we can certainly point you in the direction of professionals in that particular area. Now, as we go through the call today, if you have any questions for me as we go through the material, please type them into your chat box on the screen. Due to the number of the people on the call, I can't take live questions, but you can certainly type in as many questions as you'd like into the chat box, and I'll make sure to get those addressed. Some of the questions I may put off if it's a question that's really going to be dealt with in part two of the particular webinar that's next Wednesday, then I might delay that question and address it at that time. But for any questions that come up as you're watching today or just general questions you might have, please type into the chat box. We'll make sure to get them addressed. Now, a little bit about our company at Advanta IRA. We've been around since 2004, and our only job, the only thing that we do with at Advanta is the administration and record keeping for qualified funds. Qualified funds meaning IRAs, old 401ks, old employer plans like 403Bs and 457 plans. And again, we only do investment administration and record keeping. We do not sell any investments. We don't promote any particular investments. We exist here to hold alternative assets that you can't hold in more conventional banks and brokerage accounts. We'll talk about that in just a moment. The benefit, I think, to working with Advanta over other companies that are out there that are in this space is that we do have a superior concierge customer service experience that we give to all of our clients. Everyone that signs up at Advanta and has an account with us works with one individual to help them throughout their entire process when they're making investments, have questions on their accounts. We found, and we've got a lot of great feedback from our clients, that this is just what they were looking for. They get a lot more attention to detail. So that's the model that we have, and I think what separates us from a lot of other custodians that are out there. And speaking of other custodians, again, a lot of people will ask us when either they come to a seminar or they attend a webinar like the one we're having today, or they meet us at a networking event, why haven't I heard before that I could use my IRA, that I could use my retirement funds to invest in real estate? I think the biggest reason why is that a lot of custodians out there that administer IRAs are either banks or brokerage firms. They're offering their clients limited investments. They limit their clients to what that bank or brokerage firm is going to sell, what they promote. So they're not going to advertise to their clients that they can invest in other things that they don't sell. It'd be similar to a fast food restaurant advertising or telling you that if you wanted a hamburger today for lunch, that if you go to a hamburger chain, and they suggest you want pizza or do you want tacos. It doesn't make sense for them to advertise something that they can't serve you. So within the IRA space, a brokerage firm or a bank is not going to offer you or tell you about buying real estate, about investing in notes and mortgages, about investing in private placements, precious metals, crowdfunding projects, etc. That is something you have to find on your own. The IRS regulations, though, allow for a very broad range of investments. So individuals who want to invest in the things we're going to talk about in the next this two-part webinar, you can certainly hold. The IRS regulations permit it, but each custodian, whether it's a bank, a brokerage firm, or if it's a self-directed company like ourselves, each custodian can decide what it is that they're willing to hold. The IRS only says you can't buy life insurance and you can't buy collectibles. The only two prohibited investments within a self-directed IRA account. Again, each custodian can decide what it is that they're willing to hold, and currently self-directed assets really only account for 4 to 5% of total IRA investments. And I don't believe that 95% of America or 95% of people with retirement accounts are happy with their options. It's, again, I think the fact most people just simply don't know this is possible. So why do people buy real estate in an IRA account? Why would someone who has money sitting in a mutual fund account, has money sitting in a stock account, why would they look to buy real estate in IRA? Well, here's a list of the things we've heard over the years from our clients and people we've talked to about why they're choosing to self-direct. For a lot of people, the benefits of being self-directed can be very simply just getting money out of the stock market and into hard assets, into assets that they can touch, they can see, tired of the roller coaster, tired of the ups and downs in the market, wanting to just get their money into something else that they can see, they can touch, and feel more comfortable with doing that. Others, and again, these reasons are not exclusive of each other, but other people have mentioned the fact that they simply wanted more control. Okay, putting your money into a mutual fund account or putting money into a stock account felt like they really didn't have a lot of either choices, didn't have a lot of control over how those assets performed. By self-directing and choosing something different like real estate, you in turn get more control over what it is that you're looking at investing in. For some clients, investing their IRA in a self-directed capacity is a tax decision. When you invest an IRA account, whether you're investing into mutual funds or you're investing into real estate, there's no tax consequence to you for making that investment. So when your IRA purchases real estate and receives rental income, or you use your IRA to rehab a house and receive the profits from that sale, that money comes back into your IRA without any tax consequences. The investment is all held underneath the IRA account, so you don't have to worry about what tax implications are going to come from holding this particular investment. So again, for some clients looking at some good returns or some good profits, the ability to do this inside an IRA keeps it tax protected. And lastly, for some clients, it's just a matter of diversifying, getting your money into different baskets. So the market hits in one area is not going to affect another area. It's really getting more diversity than just simply picking a bunch of different mutual funds. So what types of real estate investments do we see in an IRA? We see individuals holding raw land. We see individuals holding commercial property, people buying residential condos or duplexes for long-term rental, long-term rentals or even short-term rentals as well, depending if you're in a resort area perhaps. Individuals' short-term projects, rehabs and flips. People investing into tax liens, mortgage notes, private partnerships, private LLCs. I mentioned crowdfunding as well as something that's become more popular in the last few years as well. But people looking, real estate is a pretty broad category. And as long as you are looking at it from an investment perspective, your IRA is looking at a rental or a rehab or a private partnership type scenario, then your IRA can certainly make that investment. There are some restrictions about what you can do with the property, which is why I mentioned it has to be investment. You can't buy a personal residence, can't buy a vacation home. But when you're talking about investments, any type of real estate will qualify. And we'll go through, again, on part 2, more of the examples of how those deals get structured and what those deals look like for your particular IRA account. And now the types of accounts that are out there, and we're going to get into the do's and don'ts in just a moment, but the types of accounts that are out there, any type of IRA can be self-directed. You have a traditional IRA, have a Roth IRA account, or if maybe you own your own business or you work for a small business and you have a SEP or a simple IRA, any account with that designation can be self-directed. It's a matter of moving that money into the right type of an account with Advanta to then be able to self-direct. Also, what's missed sometimes, people hear self-directed IRAs and they think, well, I don't have an IRA account. I simply have a 401k, or I have a 403b, or I have a thrift savings plan. Anytime you have a former employer's plan, that money can also be rolled over into a self-directed IRA account, and then in turn obviously put into the investments we're going to talk about today. Individual 401ks, if you own your own business, it's a special solo or individual 401k plan that you can set up just for yourself. And you can also self-direct education savings and health savings accounts as well. And I'm not going to go into any more detail about the differences between these types of an account. If you have those questions, that's a great question to take offline and give me a call. I'll have my contact information at the end. Great question then if you're looking to start an account, or you have something you want to know exactly how those work. But just know, if you are listening to the webinar today and you have one of these types of an account that's on here, it certainly can be utilized in the different investments we're going to talk about. So again, today's title is the do's and don'ts of real estate in an IRA. The very first do is to realize that you can combine a number of accounts sometimes into simply one IRA. If you have a traditional IRA or a SEP IRA, or you have a simple IRA that's been open for at least 2 years, or any type of old employer's plan, those monies can all be combined into simply one self-directed traditional IRA. Those amounts are all tax-deferred accounts. The traditional IRAs, the SEPs, the simples, and those old employer plans are all tax-deferred, so they can all be then put into the same buckets. We've had clients over the years that have simply consolidated their accounts with different firms into one account with Advanta, pool that money together, that then enables them to make these different real estate investments. It is only Roth funds, Roth IRAs or Roth 401ks that are tax-free money, not tax-deferred, that have to be maintained in a separate account. Again, if you want more information on the differences between Roths and some of these other types of accounts, please give us a call afterwards. I'd be more happy to walk through that particular example. Now, when you're looking to move funds from those different accounts into a traditional IRA, or if you're just trying to move money between accounts, it's good to understand how that process works. If you have money in an IRA, like you have an old traditional, you have an old SEP IRA that you're rolling into a traditional IRA with Advanta, the actual term is considered a transfer. It's a trustee-to-trustee event where the money goes from one IRA to another. The money doesn't touch your hands, and it's a non-taxable, non-reportable event. If you do have funds in an employer-sponsored plan, like a 401k or a 403b plan, you can also move that money tax-free to an IRA by doing it's called a direct rollover. It's a non-taxable movement of funds. The money doesn't touch your hands. It goes directly from your old 401k in your traditional IRA. Now you're able to then in turn self-direct it. The last way of moving funds, we typically, I guess we frown upon it to some extent, encourage people not to do that. But you can do an indirect rollover where you take money out of your accounts personally, take personal possession into your own bank account. You have 60 days to get that money back into an IRA to avoid taxes. But if you're looking at self-directing and you have money in an IRA or an old 401k, we'll work with you to get that transfer direct rollover done so that you don't have to worry about any calendar days, any taxable events coming for your IRA by doing either a transfer or a direct rollover. Kind of our first don't. Don't take early distributions from your IRA to make this real estate purchase. I've heard a couple of different people over the year I've talked to over the years come to us and say, I wanted to invest in real estate in my IRA account, but when I talked to my advisor, he said I was going to have to simply take the money out. I was going to pay penalties and taxes and able to use these IRA funds to invest in real estate. Again, I don't know if that advisor was misinformed, if they were trying to mislead their client, but I've also met somebody once that actually had done this. They were taking money out of their IRA account as a distribution, which was then subject to taxes and possibly early withdrawal penalties depending on their age, and then using whatever money was left to then go buy the real estate and owning that property personally. And they were paying taxes as well on any future gains, any future income that they received personally. It's important to remember that the IRAs are their own separate legal entity apart from you personally. The IRA as its own entity can hold title to real estate. Okay, so your IRA, you don't have to take money out of your IRA to buy it personally. Your IRA as its own entity can buy that particular property. By keeping the money inside that IRA and having the IRA as the owner, You're not going to have any taxes to do. You're going to have more cash to invest. And then as well, any future gains, any future income is all going as well back tax-free back into the IRA. So you don't have to worry then about any tax implications for your IRA account. Again, as we move through the do's and don'ts, please make sure to get your questions typed into the chat box. I'll make sure I get to them as we go along. Another do make sure that you are doing your due diligence. When you're investing into real estate within an IRA, and I guess really for any investment you're making, it's important you do your due diligence. But I do want to make sure everybody understands kind of what we do and what they need to do when you're buying property and you're making investments in your self-directed IRA. Due diligence for a property, you're looking to buy a property. That can include, inspections, appraisals, using professionals, whether an attorney, a realtor, someone else, to help you out in making those decisions and evaluating that particular property. When you're dealing with people, whether it's your IRA making a loan to somebody, whether it's your IRA buying property from somebody, you might want to do background checks, internet searches, word of mouth, talking to people in the community, talking to people that might know that other individuals, trying to get some personal references to really decide how you're dealing with this person, or should you be dealing with this person from the get-go. What's important to remember that Advanta, as a record keeper of your IRA account, we do not do any due diligence on the investments you're making. Our responsibility is to make sure that title to the asset, in this case real estate, is taken correctly, and we'll get into that in a little bit. It's also, we can then refer you to CPAs or attorneys if you need more advice. Again, you're making the investments at your own direction. So you tell us what you want to purchase. Our job is to make sure it gets titled correctly and make sure the process is followed so that there's no tax implications. But as far as doing the due diligence on whether or not this is the right property and the right investment for me, or should I be dealing with these people that are involved in the transaction, it's up to you to completely look into whether or not that person is someone that you want to do business with. Another don't deal with and transact with certain disqualified persons. In this particular slide, it illustrates a little bit what some of the rules are for what the IRS prohibits. We talked about life insurance. We talked about collectibles as disqualified investments. But the IRS also says there's certain disqualified persons that your IRA cannot transact with. And they define transaction as any sale, exchange, or leasing of property, lending of money, or extending credit between the IRA and a disqualified person, furnishing goods or services or facilities, or any transaction that your IRA makes in which a disqualified person receives a benefit from the income or the assets of the plan. So that's the IRS rules. So you can't buy life insurance and you can't buy collectibles. And they also say there's certain prohibited transactions that you cannot make inside the IRA. Again, with disqualified persons, it's those things we listed there: sale, leasing of property, lending of money, etc. Now, the penalty for engaging in a prohibited transaction is pretty severe. The IRA ceases to be an IRA as of January 1st, the year that prohibited transaction took place. So your IRA is deemed distributed to you that year, and then the IRS can go back and assess back penalties, back taxes against that particular you and your IRA. So be very careful about dealing with disqualified persons. I guess that question then brings up, who is disqualified? Okay, again, the IRS rules say your IRA can't transact with disqualified persons. So who is somebody who's disqualified? Well, the disqualified persons include yourself as the IRA owner, your spouse, your parents and grandparents, your children and grandchildren as your lineal descendants, as well as any spouses of lineal descendants as well. So your son-in-laws and daughter-in-laws are also considered disqualified persons. So the actual people, again, yourself, your spouse, your parents, grandparents, kids, grandkids, spouses of your kids and grandkids, and then also any business or entity that is owned or controlled by one of those parties as well. Okay, so this is who the IRS considers to be disqualified from transacting with your IRA account. To go through a couple of examples of what a transaction might be with a disqualified person. If your IRA, as its own entity, wants to buy a piece of real estate from your son is disqualified, that would be a prohibited transaction. If your IRA owns property and you want to lease it out to your daughter, so your daughter's going to rent it from you, again, she is disqualified from then transacting with your IRA. That would also be an example of a prohibited transaction. If your father's IRA is lending money to you or your son, then that's also, again, prohibited. Your father's IRA, both you and your son are disqualified people. Further, if your IRA buys real estate and you want to hire your son to do the actual rehab work, again, your IRA as an owner contracting with your son to do the work is going to be prohibited. Again, so these are just some of the examples of what a real estate transaction might look like with somebody who's disqualified. Brothers and sisters, aunts and uncles, other third parties, the transactions we're describing here in this slide, certainly fine to do with those particular individuals. It's only when you're doing these transactions with somebody who's disqualified that it can become prohibited. Now, I did have a couple of questions come up in the chat box I want to make sure I get to. One says, how is the real estate dealt with at distribution time? If I understand correctly, there are mandatory distributions at a certain age and voluntary distributions prior to that. How is real estate distributed and how are those distributions taxed? And as far as distributions, are they taxed as ordinary income or do the traditional IRA benefits of real estate carried through on distribution? Address that last question first. If you're taking a distribution from a regular IRA, the monies that come out of that IRA is ordinary income to you. So long-term capital gains taxes, other things like that don't carry through to that distribution. So you would have ordinary income on distributions. Now, if you get to distribution age time, you're over 59 and a half, when you can take a voluntary distribution, you can certainly withdraw whatever cash you want out of the account. If you've had rental income piling back into the IRA, you can certainly distribute the cash. As that is there, you can leave the real estate alone, and you don't have to distribute that. Once you reach age 70 and a half, there is a mandatory distribution. So at 70 and a half, you're required to take a minimum distribution that's basically 3 to 4% of your entire IRA value. You can satisfy that distribution simply taking cash. You can, again, leave the property alone and satisfy that distribution out of cash in the account. If it got to the point where you didn't have cash in that account or any other account and you had to get to the property, you can distribute the property by having it deeded from your IRA to you personally. And when you do that, you just simply do a deed and you would be taxed then on the value of the property that comes out of the IRA to you personally. So it's simply included in your ordinary income. I think it's happened very seldom that we've actually had a client distribute a piece of property from their IRA to themselves personally. They've usually been able to satisfy those required distributions through the cash in that account or cash in other accounts as well. We had another question came up and said, are these slides going to be available for download? And the answer is yes. Well, two things. We're recording this webinar. You can go back and watch this webinar on our YouTube page within a couple of days. We will also send you an email with all of these slides attached as well. Question again, asking to the prohibited transactions. If my company manages a property that my IRA funds are involved, would I be breaking the IRS laws? The answer to that question would be yes, if your company that you own and control is receiving in the rents and paying the bills, and then your company is taking its 10% fee or whatnot for being a property manager, then yes, that would be breaking the IRS rules as far as prohibited transactions. If instead you are, in a sense, just overseeing the property and directing your rents from your property to come back to the IRA, and we deposit them, and then you direct us to pay bills, so you or your company is kind of managing it just as an overseer, and you're not taking any fees, that I think is fine. That's kind of a little bit of a nuanced question, and we can certainly discuss that more with you afterwards or in a different conversation. But if your company or your business that you own is not permitted to be receiving that money in that's intended for your IRA, and certainly not available to receive any kind of compensation for doing that type of activity. But if you're not being compensated and you're just simply overseeing it, that certainly is fine. Again, a great question so far. If we have more come up, please get those typed into the chat box, and we'll get those asked. Oh, great, another one just popped up. How do you distribute property or real estate at age 70 and a half? Again, if it got to 70 and a half when you're required to take your minimum distribution and you need to distribute the property, at that time, you would get an appraisal done on the properties to establish a value of the real estate. And then you would also have a deed drafted, a quit claim deed or a warranty deed drafted that your IRA would sign to you personally to actually transfer the title of that property to your personal name. So how do you distribute it? You get an appraisal done to establish a value, and you have a deed drafted to transfer the title. And we would sign the deed on behalf of your IRA. That deed gets recorded, and now that asset, that real estate, is held by you, and that distribution would be taxed at ordinary income. So we would issue a 1099 for the value of that property to you, and you would report that as ordinary income for that particular tax year. Right, good. Again, great questions. Keep them coming. Move on to our next slide. Is when you're buying real estate, do make sure that you title your real estate correctly. Now, this is kind of a slide that's unnecessary almost to some extent, because at Advanta, one of our roles and one of our responsibilities is to make sure that this contract gets titled correctly. Make sure when your IRA is buying real estate that the title on the contract and on the deed and closing documents is properly in the name of the IRA. And an example of what that might look like is on this slide. The buyer's name, Advanta IRA, for benefit of John Smith, and his account number. What we can't do, what you cannot do, at least our reading of the rules, is if you've got a property under contract in your personal name, you cannot assign that contract personally and execute an assignment of contract from yourself to the IRA. That we would consider that could be looked at as a prohibited transaction. We recommend that if you're looking at buying real estate in an IRA, you can get an account opened, deposit just a little bit of money to have so the account's open, and that way when you find a property, we can get it titled correctly from the outset. We can assist you at the outset for getting that titled. It may be possible, if you had a property under contract in your personal name, it may be possible to get an addendum to the contract as long as the seller will accept and sign off on you changing the name of the contract with an addendum. It's a little bit different than an assignment, so that may be possible. But again, I think best practice is get an account open so we can assist you with that process from the outset and not have to worry about getting addendums and getting seller's approval later on. Another question popped up. I'll address it because we just talked about it. Someone said, do you mean you would deed a portion of the home or the whole home? I guess we're going back to when you're 70 and a half and you have a required distribution. The answer is yes. A mandatory distribution would only possibly be on a small fraction of the total home value. So if you only had to distribute a smaller portion, your IRA can simply deed a percentage of the property to you. So if your IRA owns a property 100%, maybe you only deed 5% of that home's value to meet your required distribution. So it is possible to do a fractional distribution of the total of the home, and so that at that point your IRA owns a portion of the property and you personally own a portion of that property. That is certainly possible to do. So it's up to you at that point when you reach that age. Again, it's one of those questions, we're getting a couple questions on it. I maybe have seen it less than a handful of times the entire time I've been at Advanta where people have deeded a house to meet that required distribution. They may have done it because they wanted to, and they wanted to take the property out of the IRA, but to meet that mandatory distribution, typically there's cash or other assets to satisfy that distribution. All right, so make sure you get your real estate titled correctly, but also make sure you don't do a step transaction. Now, a step transaction is basically when someone structures a deal to avoid the rules we just talked about. We talked about your IRA cannot buy a property that you already own personally. Okay, that would be prohibited for you to sell it personally to your IRA account. So a step transaction comes up when someone then tries to put a middleman or put somebody in between the IRA and somebody who's disqualified to then quote unquote try to make it legal. But a step transaction, the IRS defines a transaction as a step based on the individual's intent with the initial transaction. So in our example here, if A owns a home personally and they try to sell it to B, who's unrelated, not disqualified, and then have B sell it back to A's IRA, if A's intent at the outset is to get around the rule and get this property in his IRA, it doesn't matter how many people, whether it's B, C, and D that he puts between himself and his IRA, it's still going to be considered by the IRS to be prohibited because they look to what your intent is at the time of that initial transaction. So just keep in mind that some people I've had people ask over the years, I'll just simply do this and put somebody in between and make it legal, and that doesn't work. The IRS would consider, again, that to be a step transaction. So our next do make sure that your income and expenses flow in and out of your IRA account. The income that you receive from a property. If you're buying a rental property, you're buying into a partnership that's kicking you back dividends, if you're investing into a crowdfunding project where the money is coming back in to the IRA, that income has to be deposited directly back to your IRA, and any expense related to that investment has to be paid out of the IRA as well. So if you have a new roof, a new carpet that is getting put in, you send us that bill, we will cut a check out of the IRA directly to your vendors on behalf of the account. So we can cut a check to anyone who's not disqualified for services that they perform or any materials that they purchase. It is permissible for an IRA owner to collect the rent so long as it's deposited directly to the IRA. So if you want to have your tenant make a check payable to your IRA, mail it to you so you physically see that they paid, and then you forward it to us for deposit to the IRA, that would be permissible. We cannot accept a check from an account holder as rent. So if you had your tenant send you the check, you deposit it into your own bank account, and then want to write us a check out of your account, that will not work. But if you want to have them write a check to the IRA, you pick it up or they mail it to you and you send it to us for deposit, that would work. Question says, if you personally cannot buy or own real estate with your IRA in the beginning, why is it acceptable if you start taking partial ownership distributions? I think what you're in this question is asking is if your IRA owns it 100%, you are prohibited from doing a sale where you sell a portion to yourself and then you personally put cash back into your IRA. It's saying, why is it acceptable if you later then take partial ownership as a distribution? The reason is because in that second transaction, you're doing the distribution, your IRA is then paying the appropriate amount of tax on that particular deal. So the distributions are allowable by law. It's allowed to take a distribution of either assets or cash. So that's the reason why it's acceptable. It may not always make a whole lot of sense, but it is the IRS rules that they will allow you to distribute a part of an asset to yourself personally, but you can't sell it, where your IRA gives a percentage of ownership and you personally replace that with cash into the account. Question, if a minority interest in real estate is distributed, the appraisal for that minority interest should be proportionally lower than the majority interest, which could be advantageous. Is this lower appraised value legal? So I think what you're saying is if someone was a 30% owner then in a property, then perhaps that 30% is really not worth 30%. It's not equivalent because of the fact it's a minority interest. They're looking for a reduction in value. Is that legal? That is a great question for a CPA or an attorney to answer. At Advanta, we ask for an appraisal or we ask for a certified value from a CPA or an attorney telling us what a value is to use for tax purposes. We will use that. Ultimately, the onus is on the client and their other advisors to make sure that they can support that lower appraised value. I've certainly heard people suggesting that for the purposes of doing distributions or Roth conversions. But again, that's a question for a CPA or an attorney to give you proper guidance on. All right, the next don't perform sweat equity within your IRA account. The IRS rules prohibit you from performing maintenance personally on property owned inside your IRA account. The reason for this is you would be enhancing the value of your IRA through your own work and through your own labor. The IRS would consider any enhancement to your IRA generally as a contribution, and the IRS only permits contributions of cash to be made to IRAs. You cannot contribute your labor and your work to benefit your IRA account. So you personally should not be doing any of the maintenance on the property. Additionally, if you're paying for expenses out of your own pocket rather than the IRA, that would be an improper contribution. Okay, you're now personally paying things on behalf of your IRA, and again, benefiting your IRA account by taking on those expenses personally. That would also be prohibited. And being reimbursed by the IRA for work done or materials purchased at best is a distribution from your account, which would again be subject to taxes, but more likely would be considered prohibited. If you actually went out and fixed the roof and wanted your IRA to pay you, your IRA cannot transact with you as a contractor and employ you to do that work. So when it comes to the sweat equity, when it comes to improvements, make sure you're dealing with somebody who's not disqualified. I do, and we're talking about looking at making an investment within an IRA account. If you don't have enough money in your IRA to make this investment on your own, do look, or at least potentially look at getting leverage inside your IRA account. Your IRA is permitted as its own entity to borrow funds towards the purchase. But just know that the rules, though, for an IRA borrowing funds are very strict on how that's structured. The code section we discussed earlier today prohibits an IRA owner from extending their credit or personally guaranteeing a loan to their IRA. So if it's my IRA account making the down payment, I personally cannot guarantee that loan or extend my credit so that my IRA can get a loan. So under these guidelines, the loan that an IRA would get for leverage has to be considered a non-recourse loan. Now, a non-recourse loan is one in which a lender lends money to the IRA account, and if that loan is not repaid, the lender's only option is to simply foreclose on the property. So if there's no payment made, the lender simply has to foreclose and take back the property. For that reason, most non-recourse lenders want a minimum, they want at least like a 75% loan-to-value ratio. They want, or perhaps even better, they want you to have a substantial enough down payment that if they have to take the property back, that there would still be equity. So in this situation where you use leverage, your IRA makes a down payment, your IRA signs on the non-recourse loan, and then your IRA would be responsible for paying that loan back. So as you receive rental income in the account, the IRA would simply make the loan payment. Another option, if you don't have enough cash in your IRA to make that purchase, is to look at a partnering transaction. Now, this is going to be a little bit different than we talked about a minute ago with transactions, but partnering within an IRA is permissible. Your IRA can be a partner alongside any other individual, anybody else's IRA, or certainly any other type of entity. When you buy property in a partnering arrangement, it's generally done as a tenants in common relationship with the ownership percentages indicated on the deed. So if you buy a property on the deed, it might say that your IRA owns 50% and your other partner owns 50%. You could also partner inside an LLC or some other entity. But the IRA will receive its portion of expenses, would pay its portion of expenses and receive its share of income as well. Now, if you're looking to partner with somebody who's disqualified, that may be possible if you're partnering on the initial purchase and you understand that the percentage ownership cannot be changed at a later date. Now, the partnering, again, it can get a little bit confusing. What I would advise someone to do if you want to look more into partnering, two things: either call our office, or B, join us for the second part of the webinar. Okay, this is basically concluding part one of today's webinar. Part two that will come up next Wednesday, we'll talk about actually structuring the purchase, where we will discuss different purchases for an individual, different ways to buy the real estate, and certainly how to partner in that particular investment as well. I did have one more question pop up that I'll address quickly. Is the mortgage interest paid by the IRA in a non-recourse loan tax deductible somehow? The answer is yes. If your IRA is paying a mortgage on a non-recourse loan, the IRA can deduct the interest that is paid because your IRA will actually be subject to a tax in that circumstance. It's very rare that an IRA is subject to a tax. So if you do borrow funds with a non-recourse loan, your IRA would be subject to a tax on part of the income it receives, and therefore can deduct the mortgage interest to reduce that tax. Again, another question, probably a good thing to call us offline on and get more into information and go through that particular example. But again, I wanted to keep today's webinar shorter. I hope everybody enjoyed it, and make sure that you're going to tune in for part two. Begin next Wednesday at noon on how to structure that real estate purchase. We'll recap a little bit of some of the rules we talked about today, but go more into the meat and teeth of how you actually make this particular investment. If you don't have questions for us prior to that time, please reach out to me or reach out to us. Again, my contact information is on this last screen. I really appreciate everybody logging in, everybody calling in today. Hope you learned something great. please make sure to, again, join us for the next part 2 coming up. And if you have questions, please reach out to us or visit our website at advantaira.com. We list all of our upcoming events, seminars. If we have any guest speakers that will be joining us, those events are listed on our website, and we look forward to hearing from you.